Welcome back. You're watching Big Deal. Now, put call option issue is seen as a big hurdle on the M&A street. It's not new for any of us, but two recent events have really triggered off a debate around this subject. Now, an international arbitration court has ordered Tata Sons to pay $1.17 billion to NTT Docomo for breach of contract on the grounds that Tata's neither found a buyer nor bought back the Japanese partner's 26% stake in their telecom joint venture, Tata's Teleservices. Now, Allianz is also unable to raise its stake in insurance joint venture with Bajaj at a predetermined price and will have to go by the current market value. So that's put a spanner in that deal as well. What's the remedy of this ongoing debate? Let's find out from Nishchal Joshipura, who's joining us to throw more light on this. Nishchal, good to have you on the show. Now, my first question, this entire issue of put-call options and how it really is impacting our deals is to be seen in a new light with the new arbitration, court order that has come in for Tata. And a lot of the future deals could also get impacted, like in the case of Bajaj Allianz that we have seen.
So I think clearly, as far as foreign investors are concerned, one of the biggest worries while investing in India has been that when they invest in India, at that time there is a certain set of laws which are there, based on which they do the deal, they negotiate contract with the Indian partner. And when the contract needs to be enforced, there is a different set of provisions under the law which make it difficult at times to enforce that contract. Just like we are having grandfathering concept under the tax laws, and as we saw for general anti-avoidance rules and even under the Mauritius-India treaty which has been renegotiated, the government has made its stand very clear that all the investments which have been made prior to 1st April 2017 will be grandfathered. Why can't we have a similar concept even under our regulatory regime, where if certain investments have been made based on the laws that existed at the time when the investments were made, even though the laws change after that, at the time of exit, they should still get the benefit of the laws which were prevalent at the time when the investment was made.
Oh, clearly, Nishchal, in fact, retrospectivity is the biggest issue in this particular aspect as well, like we have seen in the cases of tax. Is grandfathering that you mentioned a very important remedy coming in the tax side? Is that also talked about by our regulator here?
So, I don't think there is a precedent to this, especially, in a large joint venture like this. I don't think there is anything being done by the government on this particular issue. I think it's important on how the contracts are drafted, and this is exactly what happened in the Tata Docomo case. Again, we are not privy to the documents, either the agreements which was signed between Tata and Docomo or the arbitration proceedings. But what is available in public domain is that even though certain transaction in the form of exit was not possible as per the pricing restrictions under the Indian exchange control regulations, the argument that was made in the Tata Docomo case was that 50% of the investment price was promised for the purpose of exit to Docomo, and in spite of regulatory restrictions, since Tata had committed under the contract that they will be obligated to comply with the provisions for giving exit to Docomo, the arbitrators in London, they awarded damages to the extent of the minimum price that was negotiated by both the parties.
It's a very important differentiation that you have mentioned, Nishchal, because of course, when we talk about assured returns, that is one thing which the RBI's regulation clearly stated that you cannot get. It can't be in the form of quasi-debt and fixed return instruments when you're making equity investments. But on the other hand, the investors are also assured or have a right to a safety net. That is the case in Tata Docomo. But in the midst of all this, while there is a huge penalty slapped on an Indian company, it is putting the Indian companies at risk as well, who are just following the new regulation.
That's correct. And again, I think the most important point there is how the contracts are drafted. Now, if the contracts clearly say that, these exit provisions or the provision to increase your stake is subject to applicable law existing at the point where these transactions are going to take place, then there is not much with the foreign investors will be able to do because clearly they themselves had signed up on something that they will be complying with the laws at that point in time, versus a situation where similar type of language is not there and there is a strong obligation which is clearly documented in the agreement, where the Indian party is committing to the fact that they will ensure whatever is possible to perform their obligations under the agreement. So I think we'll see different types of outcomes in similar situations depending on how the contracts are drafted between the two parties.
All right. Thanks, Nishchal, for joining us with all your views. All right. With that, we've come to the end of this episode of Big Deal. But wrapping up our three key discussions that we had. First of all, Nishchal Joshipura says that grandfathering of regulations is an important remedy, like is done in the cases of tax issues. It could be really implemented for put-call issues as well. As far as the Cyprus tax treaty is concerned, well, fine print is going to be very important for the specifics, especially in the case of extent of grandfathering that has been provided, and also withholding tax on interest. When it comes to the big event of Brexit, it will present M&A opportunities for Indian companies as well, and many strategics around the world, as UK assets are looking much more cheaper because of a weaker pound. But it also will test the risk appetite of the investors there. All right, with that, it's a wrap from me on this edition of Big Deal. Keep it with CNBC TV 18.